All right, take a step back for a second, because this story may look like aviation news on the surface, but it's not. It's economic strategy, it's political leverage, and it could become one of the defining North American tensions of 2026. Breaking. Canada is preparing to slash billions of dollars from US bound air travel. Not millions, billions. And if this trend accelerates, the consequences won't stop at airport terminals. They will move through tourism, retail, trade corridors, investment flows, and ultimately straight into American politics. Let's unpack this slowly because what's happening here is subtle but potentially seismic. For decades, the United States and Canada have shared one of the deepest economic relationships in the modern world. This is not a distant alliance, this is daily integration. Every year, tens of millions of travelers cross the border by air. Canadians consistently rank among the top foreign visitors to the United States. In peak winter months, Canadian snowbirds flood Florida. In summer, they fill hotels in New York, California, Nevada, and across the Midwest. In raw numbers, Canadian visitors spend tens of billions of dollars annually inside the United States. Hotels, restaurants, theme parks, shopping malls, casinos, rental cars, sporting events. Now imagine even a 10 to 15% contraction in that flow. That's not a rounding error. That's an economic shock to local ecosystems that quietly depend on Canadian dollars. And that's what industry forecasts are beginning to signal for 2026. Airlines are adjusting capacity, routes are being reviewed, seasonal frequency is being trimmed, tourism boards are recalculating expectations. And while officials describe this as market adjustments, the underlying driver appears to be rising political and economic uncertainty between Washington and Ottawa. Under a renewed Trump political landscape, whether in office or in a dominant policy role, trade rhetoric has hardened. Economic nationalism has returned to center stage. Tariff threats, renegotiation language, border enforcement expansion, energy independence framing. From a domestic political perspective, this messaging energizes a voter base. From an international economic perspective, it injects volatility. Canada is watching carefully because Canada's economy is deeply exposed to U.S. policy shifts. Nearly 75% of Canadian exports go to the United States. Energy grids are interconnected. Automotive manufacturing is cross border integrated. Supply chains function as if the border barely exists. When Washington signals unpredictability, Canadian businesses do what businesses always do: they hedge. Hedging doesn't require public confrontation, it requires adjustment. And air travel is one of the fastest adjustable economic levers. Airlines operate on thin profit margins. They constantly reallocate aircraft based on projected demand and geopolitical stability. If corporate executives anticipate trade friction, they travel less. If tourism agencies sense policy hostility or currency disadvantage, they redirect marketing. If consumers feel uncertainty, they vacation domestically. These small behavioral changes aggregate into billion-dollar shifts. Let's be clear, no official Canadian policy document says reduce flights to the United States. But markets respond to tone. If political messaging between leaders grows tense, that tension translates into consumer psychology. And consumer psychology drives ticket purchases. Now let's zoom into the regions most vulnerable. Border states are the first to feel it: Michigan, New York, Washington State, Vermont, Maine. These areas rely disproportionately on Canadian visitors for shopping, entertainment, healthcare services, and seasonal tourism. Take Detroit and Windsor, for example. This cross border region operates almost as a single economic organism. Reduce air connectivity and cross border corporate mobility slows. Conferences relocate. Supplier visits decrease. Investment hesitation grows. Or look at Florida. Canadian snowbirds represent one of the most stable seasonal tourism groups. Entire condominium communities depend on them. Restaurants hire based on predictable winter traffic. If Canadian bookings drop meaningfully, that reverberates through employment. And in a politically charged year, local economic pain becomes national narrative. Now, here's where the tension sharpens. Donald Trump's political identity is deeply tied to economic strength, negotiation leverage, and America First positioning. Supporters argue that tough trade stances extract better deals. Critics argue they strain alliances. If Canada's economic signals begin to show distancing, even indirectly, the opposition narrative becomes powerful. America's closest ally is stepping back. That headline writes itself. And perception matters as much as data. Markets move on expectations, not press conferences. Let's widen the lens even further. Globally, 2026 is not unfolding in a vacuum. Europe remains economically fragile. China continues to assert influence in trade corridors. Supply chains are still adjusting from pandemic era shocks. Energy markets are volatile. In that context, North American stability becomes a cornerstone of global investor confidence. If the US Canada axis shows cracks, even symbolic ones, international investors price additional risk into North American assets. Risk premiums rise. Borrowing costs inch upward. Growth projections soften, all from what appears to be just aviation. But aviation is connective tissue. Air connectivity correlates directly with business dynamism. Fewer direct flights mean higher friction in corporate expansion decisions. Imagine a multinational company evaluating whether to expand operations in Chicago or redirect resources to Europe. Ease of executive travel matters, route frequency matters, confidence in political relations matters. If the environment feels unstable, capital flows elsewhere. And once capital relocates, it rarely returns quickly. Now, to remain objective, we must acknowledge alternative explanations. Currency dynamics play a role. If the US dollar strengthens significantly against the Canadian dollar, American vacations become more expensive for Canadians. Inflation pressures inside Canada may also shift travel preferences inward. Post pandemic normalization continues to recalibrate demand patterns. All of this is valid, but scale changes interpretation. If the reductions approach multi-billion-dollar magnitude, that suggests something deeper than seasonal adjustment. It suggests strategic economic repositioning. And here's the strategic dimension few are discussing openly. Canada has spent years diversifying trade relationships beyond the United States, expanded agreements with the European Union, strengthened Asia-Pacific ties, energy export diversification, digital trade frameworks. If Ottawa accelerates this diversification while subtly reducing U.S. centric exposure, Washington's leverage over time decreases. That's not retaliation, that's long term risk management. And risk management rarely makes dramatic headlines. It unfolds quietly, flight by flight, contract by contract, investment by investment. Now consider the political calendar. If economic metrics soften in key swing states, reduced hotel occupancy, declining airport passenger counts, small business revenue dips, opponents will connect those dots directly to federal policy tone. Whether that connection is entirely fair becomes secondary. Politics thrives on simplified causality, and economic anxiety spreads quickly. But let's flip the scenario. What if this becomes leverage for Trump? What if the narrative shifts toward renegotiation strength, arguing that short term pain yields long term trade advantage? In that case, reduced Canadian travel could be framed as temporary turbulence before a better deal. This is the political gamble. Short term economic friction versus long term positioning. The risk lies in duration. Temporary disruption can be absorbed. Prolonged economic cooling becomes structural. If Canadian travel patterns shift permanently toward Europe, Mexico, or domestic tourism, recapturing that market becomes expensive and slow. Brand perception matters in tourism. If the US becomes associated with unpredictability or policy volatility, consumers adapt habits. Habits solidify into patterns. Patterns solidify into economic realities. And airlines, once they redeploy aircraft to alternative profitable routes, do not reverse decisions lightly. Fleet allocation is strategic. So the real question is not whether flights are being reduced, it's whether confidence is eroding. Because confidence is the invisible currency of geopolitics. You can measure tariffs, you can measure passenger volume, but confidence? That shows up in investment hesitancy, cautious boardroom decisions, delayed hiring plans. It shows up in fewer planes in the sky. Now let's address escalation risk. Is this heading toward open trade confrontation? At this stage, unlikely. The interdependence between the US and Canada is too deep for reckless decoupling. Energy interconnection alone prevents dramatic rupture. But cooling relations don't require rupture to create damage. Gradual distancing is enough. And gradual distancing is harder to reverse than headline grabbing conflict. Because it lacks urgency. No emergency summit, no dramatic tariff announcement, just incremental recalibration. In geopolitics, slow shifts often matter more than sudden shocks. By the time sudden shocks appear, the structural movement has already occurred. So, where does this leave us? We are at an inflection point. Billions potentially redirected, regional economies potentially pressured, political narratives potentially sharpened, alliance confidence potentially tested. This is not a collapse, but it is a signal. And signals in geopolitics demand attention long before crises emerge. If Washington and Ottawa stabilize messaging, reaffirm trade frameworks, and project predictability, travel flows can normalize. Airlines respond quickly to positive demand signals. Tourism rebounds when confidence returns. But if rhetoric intensifies, if uncertainty persists, if policy volatility dominates headlines, economic actors will continue adjusting quietly. And those quiet adjustments accumulate. By the time election season reaches full intensity, the economic data will tell a story. Passenger numbers, retail sales in border states, hotel occupancy rates, small business surveys, those numbers will shape perception, and perception shapes political momentum. So the real headline may not be Canada slashes flights. The real headline may be this: is North America's most stable alliance entering a new era of cautious distance? That's the strategic question. Because in the modern global economy, power isn't only measured by military strength or tariff policy. It's measured by who others choose to integrate with. And if integration begins to thin, even slightly, the long-term implications stretch far beyond airports. Sometimes geopolitical shifts don't arrive with dramatic speeches or sanctions. Sometimes they arrive quietly, in reduced bookings, in trimmed flight schedules, in billions slowly redirected elsewhere. And by the time the sky looks emptier, the realignment has already begun.